Joining us tonight with the webinar titled Trading Intraday Divergences in the Euro with the MQ Indicator Suite. Now, for those of you who are familiar with microquant, our primary product line features the value charts indicator suite, but we've also done a lot of research to try to find some other indicators out there that are very complementary, and those indicators are what we call the MQ indicators, and those are really the best indicators to measure any type of divergence or even measure momentum and possibly measure trend as well. So that's what we're going to be talking about tonight. And Thomas, if you want to go ahead and start, I guess you've already started the recording, we can go ahead and kick things off here. So thanks for joining us tonight. I will go ahead and start the webinar right now. I'm sure we'll have a few people join us here over the course of the first couple of minutes of the webinar, but they can always watch the video if they're too late. So. Okay, let's talk about just a basic risk disclaimer. I always try to do this just to make sure that we are very careful to communicate that trading does involve risk. And even with this, our confidence in the fact that we believe our indicators are very powerful and very effective over time, that there's no guarantee for any of us, any person, that they're going to be profitable. So make sure you take the time to understand the risks of trading, and then also be aware that for any type of hypothetical or simulated performance results, we're not really going to talk about that today, but those have inherent weaknesses in them. Anytime you do a simulated test, even inside of a quantitative system development platform, the results that you're looking at are really from a certain snapshot on history, and there can be some inherent weaknesses in those. So make sure you understand that before you trade. If you don't understand the risks associated with it, then it's going to be very difficult for you to be successful longer term. So risks are okay as long as you understand what those are. And our goal at microquant really is to minimize those risks with the trading that we end up doing. Let's go ahead and dive right in. The MQ indicator review is going to be the first section of the webinar tonight, and there's a number of very exciting strategies and indicators that we have included in the MQ indicator suite, but let me just go over a couple here. The first one is the MQ momentum indicator. This is probably one of the ones that I use mostly, and Thomas uses as well in the live trading room. Momentum is a critical part in analyzing any market from a technical analysis perspective. The MQ momentum indicator is a combination of it's a double smoothing algorithm that also has a look-back period, so we can create a primary indicator line, and that line is the primary solid blue line here, and then the indicator line, or the trigger line, the signal line we call it, is actually the dashed line here that's trailing it. The histogram that you see right here is generated from taking the difference between these two lines and multiplying a factor by that so we can see it more clearly. Now the idea is that typically when we see the histogram line approach the upper boundary of 25 or negative 25, then momentum has really reached an extreme point, and so it can be overdone a little bit, just like value can. And so that's what these two lines are for. You've got a plus 25 line and a minus 25 line here. So just take note of that if you see the histogram reaching or exceeding the top of this, then you know that momentum has really been strong for that period of time, and chances are you might get some sort of correction or at least some sort of rest with the market or consolidation. So that comprises the MQ momentum indicator. One of the things we're going to take a look at tonight is what happens if you adjust these parameters here, especially really focusing on the first two, but also the third one as well. That's going to give you a different look of the market, and believe it or not, it can communicate some very different information and very powerful information with respect to what's happening. We're going to focus our analysis really on intraday price movement for specifically the euro currency market, but it's important to understand that even though we have these default parameter settings for the indicators that we're presenting, these are just defaults. I mean, there's a lot of different settings here, and I would encourage you to play around with those to get a different snapshot of the market. And it's not to say that the 32, 5, and 5 is the right setting. It may be maybe a 50, 38, 10 could be a combination that actually gives you more insight into what's happening. with the market. Now, one thing to note about the currencies is that currencies tend to be very good trending markets, better than most. So they're not quite as herky-jerky as you might expect the stock indices to be or some of the other commodities to be. They're very nice trending markets, and so we have to exercise caution when we talk about divergences and differences in the strengthening or weakening picture in the market. We'll address that more as time goes on here. The next indicator we're going to talk about, and this is just an indicator in the MQ indicator suite, but this is not an indicator we necessarily use for measuring divergences. Now, having said that, this is an indicator we often use as a filter. And the idea here is the green dots that are underneath the prices represent or communicate that a market is in a bull market mode, and the red dots above prices suggest that the market could be in a bear market mode. Now, sometimes you're in consolidation modes where you see a rotation of the red dots and green dots, getting whipsawed a little bit, and that happens with any type of trend filter. But in general, if you do start to see a trending period, then this could serve as a filter that might help you determine what side of the market you want to trade from. Certainly with all these green dots here through the end of January and really through yesterday, this would suggest that you ought to be looking for opportunities to buy on dips here when the market becomes overvalued, and as we'll see shortly, as the market experiences different types of divergences with price. This is another indicator that we use to determine trend in a market, and we call this the MQ Trend Index. And the idea here is when you see a green histogram bar, you're in an uptrending environment. And when you see a blue histogram bar, you're in either a reversal environment or a consolidation environment. And tonight we're actually going to be looking at the MQ Trend Index, not so much in terms of the trend features, but we're going to be looking at this indicator to help us determine when we might be seeing some sort of divergence or shift in short-term supply and demand. So keep that in the back of your mind. Excuse me. Okay, let's also, the red histogram bars here on the bottom represent a downtrend or downtrending environment, and the magenta bars are communicating either a reversal or consolidation. One nice thing about the MQ Trend Index is it's very responsive for a trending indicator. You'll notice that, in fact, I'll go ahead and pull out my pen here. You'll notice that let me use orange as a color here. You're going to notice that if you look right here, when the bars turn from red to magenta, it's pretty close to the bottom, okay? Or when they turn from green to cyan here, that's pretty close to the top. So it's a very reactive trending indicator, unlike what we might see from moving averages that tend to lag a lot more. Now, the give and take portion of that relationship between how reactive a trending indicator is and how much how effective it is at not being whipsawed, there's really a give and take relationship there. You'll notice that in this area right here, we're oscillating a little bit between trending or reversal and consolidation, even though we see a little bit of a stair-step trending environment here. And part of that could be from the parameter selection here. And again, I would challenge you to play around with different parameters there. The higher the parameter numbers here, the less sensitive it is to these type of corrections or these type of gyrations with respect to the colors going from green to cyan in this, this overall uptrending environment. So there's a sensitivity aspect of this indicator, and the more sensitive you make it, the more rapid it responds to changing trends, but also the more vulnerable it is to false moves or whipsaws as well. And that goes really for every type of trending indicator on the market. This is an indicator we call MQ migration, and we haven't used this a lot, but it's really a neat indicator, and it's pretty powerful too if you learn how to use it. This is detecting the value migration in a market. So right here we can see during this period, you can see a lot of red here, red and blue. That's showing that the value is going down. That means the market's pushing the value down, and you're seeing a short-term value migration to the downside. So during this period, You see the red here. Blue means there's no value migration really occurring. So right here in this blue area, you're going to see right up here that it's really kind of just a sideways consolidation period. The market is content with fair value staying there. If you see the red here, that means fair value is shifting lower. And keep in mind that value is time dependent. So this is a 5-minute chart here, a very short-term snapshot. This could be, a matter of this whole time period on a 5-minute basis could be overvalued on a daily basis or on a weekly basis, but possibly, undervalued on a 5-minute basis, so, or vice versa. So understand that every time frame and market combination has its own unique value. And so this is an indicator we use for that. Now, in terms of divergences, this again could be used as an indicator that we can use as a filter somewhat in terms of how we, where we get in and what side of the market we want to trade from. So this is just an indicator we want to make you aware of. We do use this sometimes, but this is an indicator that I challenge you to really study because it can give you clues about what's happening in terms of the shortness, or the longevity you see of migration, and how sometimes the downward migration introduction there, a lack of further upward migration could be a clue that you might be rolling over a little bit, or that type of thing. So there's a lot of little clues here you can see in this indicator, but it's one you have to study a little bit to figure out how you're going to use it. This is an indicator we use more often than the previous one. This is actually called the MQ Migration Index, and the reason why we call it that obviously is because it's oscillating behind or around the zero value here. So this is a terrific divergence indicator, and we're going to go into that further. But the idea behind that is if you're not seeing a value migration, we're going to flatline at zero here. So during this period, you don't see any colored bars up here in the value bars indicator. But as soon as you start seeing all these colored bars representing moderately overvalued or significantly overvalued, notice you're getting a positive histogram and a positive indicator line reading here. If you see negative bars in here, negative or lower yellow bar segments or lower red bar segments, communicating either moderately undervalued or significantly undervalued, you're getting red histogram values here. So that's showing you a migration. If there is very little or to no overvalued or undervalued trading activity, you're going to get a flat line here. Okay, and the one thing I tell you is make sure that when you can do the comparisons, this is actually not an apples-to-apples comparison because our value bars indicator has a 10-bar analysis period and our migration actually has 14 here. So just be aware of that as well. And this last parameter here, this 5, that's another one that we can use to adjust this indicator as well to look for divergences. And we're going to look through a lot of examples tonight, but just introducing that indicator right now. You've seen this if you've been in the live trading room. This is just a simple trend filter. It's a regression line that turns red during downtimes and green during uptimes. So it can be a nice indicator just to keep you on the right side of the market if you're looking to sell with the trend or buy with an uptrend or sell with the downtrend. So that's really what that is, more of a filter than anything else. The cycle finder is a great divergence indicator as well. So when you start to see a market strengthen or weaken, with the cycle finder, it could be giving you a clue that it's running out of steam in one direction, or it could be a clue that a market's going into a consolidation phase. And I've tried to kind of keep the graphs fresh here with current data history so you can see what's going on with what we've seen over the last 24 hours or so in the euro currency market. And I believe this is we're getting close to the last indicator here, but this is what we call the MQ market strength. And the idea is this blue line is measuring the buying strength from kind of a peak to valley reference. So right here, from this very low point right here, we're measuring how far the market has rallied, over a 5-bar period. And this happens to be a huge rally over a 3-bar period, but that's what that's measuring, that blue line. And vice versa, this red line is measuring how far a market has traveled from a peak level, say right here, and count 5 bars. So it's 1, 2, 3, 4, 5, down to this low right here. Okay, and that corresponds with this top right here in the red line. So selling strength and buying strength, it can be a good divergence indicator. And you'll notice right here, we're seeing kind of weakening lines here with the buying strength, or how far the market is pushing prices downward for a 5-bar period. and you'll notice that kind of coincides with significantly undervalued prices, and then also a dramatic reversal here. So combining those all together can be a good thing. This can be definitely an interesting way to read what a market's doing in terms of the supply and demand strength. Okay, let's talk about time charts versus tick charts. I wanted to include this in here because they definitely are good for different things. Okay, so for example, I like to use time charts for patterns and candlestick patterns. I like to use time charts looking at different types of geometric patterns, head and shoulders, pennants, flags, triangles, wedges. I mean, all sorts of geometric patterns, trend lines. A lot of times the time charts. When I say time chart, I mean 1 minute, 5 minute, 10 minute, 30 minute, daily, weekly, monthly. So the bar is formed with the passage of time and not trading activity. Okay, so it's better for patterns from my experience. The time charts, the weakness here is that they tend to give too much weighting to slow periods. And what I mean by that is during the day you may have a lot of volatility in the market. Market's really moving down, around and up and down, and then all of a sudden you get in the night period and you start to see the volatility really drying up, and the hours pass, and we're not seeing a lot of stuff happen. With the weakness of a time chart is that you're giving an hour here as a passage of time is the same weighting for an indicator as an hour here. So clearly during the day there's a lot more trading activity, a lot more volume than this little hour that's like 2 in the morning. So be aware of that. And what happens is this can cause your indicators to kind of it really negatively affects your indicators. You have to understand how that happens, but be aware that these nightly hours are being factored into your indicators, and that is not really indicative of really what the market's doing. Now it's certainly sideways, but you don't want it's treating these equal to these lines over here, these bars over here, and that's from an indicator's perspective, that's not really what you want to have happen, but we can live with it. It's not the end of the world. Now, time charts are also slow to generate signals in fast markets. And what I mean by that is if you have a system or an indicator that kind of triggers on the close of a bar, and then you have, let's say you have a big run up, in a price, and then all of a sudden you have one bar reversal and you have a close down here, well, your indicator is now triggering, your system on close is triggering right there. Okay, and you just had a tremendous amount of movement there. So that gets you in really pretty far into the move, and that's not very desirable. So understand too that slow to generate signals is a negative thing for time charts. Tick charts can give false patterns. That's a negative for tick charts. So for example, every 500 ticks or 2,500 ticks, you're going to see tick bars kind of generate bars essentially, and they tend to be fairly similar in size. I mean, they don't deviate as much in terms of the length, the height of the bars versus the time charts. So that if you see like a doji on a tick chart, I don't give it quite as much weighting as I would on a time chart. Okay, so just be aware of that. The tick charts can be better for trading fast movement. So right up here you had kind of the scenario A where you had the 60-minute charts, for example, and then you have scenario B for the same market, and what you'd end up seeing is you'd end up seeing a scenario where you have kind of the same run up here, and then you have the same run down here, and this is what it looked like on a tick chart. So you have a lot more closing values to generate a trade during a fast market where you see a lot of volatility. And so instead of just getting at the bottom here after one big bar down, you have 5 or 6 bars all the way down that can turn you around, turn the boat around, and turn your indicator around as well. That the negative to the tick bars also is that they can be more choppy as well during consolidation periods. The proper weighting and slow periods, this is a benefit of tick bars. So where you see this slow period at night on the time bars, what happens is let's say you have, this is night right here, and this is day right here. So even though there may be 12 hours in each, we'll say 12 hours, okay, in the day, and let's say you have 12 hours at night too. What's going to happen on your tick bars is that you may have, you may have a lot of trading activity during the day, okay, and then you get over the night and you may have this 3 bars, okay, because there's been very little volume, very little trading activity, and that's a benefit because it doesn't, all bars are really equal here. Okay, all bars are treated equal by your indicators, and all bars are generated with X number of ticks. So it could be, 2,500 ticks for a longer term one. You could have one that's 500 ticks or 25 ticks, whatever that is. We're treating all the bars equal in this scenario. And your indicators are as well. But up here, during the deads time, it doesn't matter how much trading activity happens. Your bars are generated every X number of minutes or every hour, for example. Okay, selecting the right bar interval. We can talk about that here in a minute, but let's go ahead and take a look at the examples here. I'm going to go ahead and pull up our example here with the workspace I have. I'm going to go ahead actually and forgive me here. I'm going to go ahead and also pull my pen off here because it's not going to allow me to operate effectively here in the okay, I'm going to get my cursor back here. Okay, I'm not going to be able to operate effectively on the trade station here with that pen. All right, let's take a look at some of these indicators in living color here and take a look at what's happening. This is a 15-minute chart here with the euro currency, and we can see that we have a very nice trending pattern here. Now, the whole goal of everything we're doing here is we're really learning how to read supply and demand. Now, one thing I'll warn you with currencies is they trend fairly well. So if the trend is going one direction, then you may want to just make sure you're aware of that. And even though you may see some divergences here, one thing to be careful about with the trending markets like the euro currency is that you could be facing a consolidation or continue trending in that direction, but a little bit slower. You have an advantage when prices are a little more volatile. Those divergences tend to be a little more pronounced, but really what you're looking for here in this is full of a lot of very helpful information. Okay, so for example, let's look at kind of the first incidence, if you will, of a bearish divergence. Now, notice right here you've got an indicator line, you have a signal line, which is the dotted line, and then you have your histogram. Now, we can use either of these, okay, for divergences. I'm going to point out a couple of divergences that strike me as being good divergences, okay? Now, right here, the trend is up. Really, it's going up from the previous bars, and now we go into consolidation phase, okay? Understanding that, notice what's happening right here. This is the type of thing you want to look for, okay? You have a situation where you have a consolidation period. The trend is up, okay? And if I inserted like the MQ trend indicator, for example, I'm going to go ahead, in fact, let me format that to get that on the scaling of our prices, and I'm also going to see if I can increase the weighting, make that a little more visible. Okay, so I'm going to move this up here to where we are up here. Now notice that we're seeing a bull market environment here, consolidation, and then we see another bull market environment according to our indicator, and chopping around a little bit. But if we use this as our filter, just kind of knowing we're coming in here, it's not unusual to see these things, the trending indicators oscillate or get chopped around a little bit during sideways consolidation period. But knowing that you've had a nice presence of buying in the market coming into this consolidation period, right here, this period right here is noteworthy for a couple of reasons. Notice that we're taking out the lows of the previous dip right here. So I'm going to put a blue arrow right here. Notice that you're barely eclipsing those lows. The low over in this first correction is 135.47. The low past that is 135.45. Okay, so I'll make sure I said that right. Low 135.47, 135.45. Okay, now markets are always going to be looking to run stops all day long. They love to do that because it's good money. So people know that people have gotten in here, and it's a natural tendency for people to put stops right below market extreme points. Okay, so this in an up market is a natural tendency for markets to do that. And if you're a trader and all you did was wait around all day for a divergence like this, so lower prices and higher, where you exceed the previous low, in this case for a buy signal, and a higher histogram. Now notice the histogram compared to the previous histogram. So this is a stronger selling presence here. We almost reached the negative 25 line. We see a little bit of buying presence here, right? And then we see a weakening selling here, coming down and pushing this to new lows, running the stops. There's a couple of things I would tell you to note here. You're moderately undervalued according to value bars. Okay, there again we're using a 10-bar value bars. So yellow bar segments are communicating moderately undervalued right there, and you're eclipsing, you're running the stops, the lows of the previous low, and nothing happens. I mean, nothing. It just kind of stutters and stalls out there. Okay, be aware of that. Now, unlike a lot of commodities, in general, it's not unusual to see the stock index, instead of just spiking down and coming back up, I'm sorry, the euro currency, instead of spiking down in the currencies here, or the euro specifically, it's not unusual to see it kind of linger just for a few minutes and then turn around. So it's kind of sweeping the stops. It doesn't do much. We don't see an acceleration downward. Okay, and notice that. And then you see the fact that you're looking up here at a much higher histogram reading and a higher indicator line reading. That is a very strong incidence of divergence right there. Okay, so that's the type of trade that may come along once a day. And that's the day. If you just look for those in markets and that's all you ever did, you would probably do extremely well trading, in my humble opinion. Okay, let's look at some other ones here that are more pronounced. Now, another one that jumps off the screen here at me is up here. You see a selling here, and this is one of those things where it's not just being a Monday morning quarterback and calling these out after the fact. Look at what's happening here. You see the market rally up, a fairly deep correction, you hit moderately undervalued here, and then you see another rally here. Okay, now look at where your momentum is. You see a much weaker momentum indicator line and a much weaker histogram line. Okay, and then the market's also moderately overvalued, and it can't even reach the highs here. So if you were waiting for that high, the violation of the previous highs, you would have missed out on that signal. Okay, so be aware of that. But this is a good divergence indicator. I think it's more of a momentum divergence, and that's really what we're looking for. We are looking to try to understand when a market is shifting from supply strength or buyer strength to seller strength, back to buyer strength, back to seller strength. Okay, that's exactly what we're looking for. Okay, so those are two very, very good signals. Now notice what we're seeing over here. If we go back to the beginning of the chart, watch your indicator line. You see how that's falling? So you see weakening, 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 weakening. Okay, there's two things going on here. One of two, really. We're either reversing direction or we're consolidating. And in this case, we're consolidating. So if you see this happening, even with the histogram bars, you see those really weakening as well. If you see a situation where you see weakening like this, and then you see prices spike up into significantly overvalued, okay, so notice where that is, and then down here, we're seeing a weaker indicator line, right, and a weaker histogram compared to what we've seen earlier. So this is a case where you're seeing an upper red bar segment significantly overvalued. That by itself means that prices have really gotten overdone, okay, and we're seeing the momentum slow down. That is it's an attention getter. Okay, that usually means even if you're not reversing, you'll see some type of correction. And in this case, we ended up seeing a correction of 20 pips or more. So that was even if you're just in and out of that trade, that's not a bad deal. Right when it turns significantly overvalued, you got to be quick to pull a trigger on that. Here's another case. Poking up, the market's getting emotional, buyers don't want to miss out. They shoot up, and the market gets significantly overvalued again here. Okay, and we'll look at what's happening with the momentum indicator, that line down here, weakening. So weakening, weakening, and your histograms are weakening. That's a very weak histogram line right here. Okay, so notice that whenever you see that kind of weakness there, along with a significantly overvalued valuation, then you're really that's really ideal. Okay, now keep in mind also that these indicators are developing. These indicators are driven from closing values. So it may look slightly different when you're actually trading, when that's actually up at this level, but it's not going to look that much different. So you're still going to see a lot of weakness there. And so even though these are overvalued in an uptrend, these could be situations where you could do a quick value range trade. And in this particular case, you actually get the value range trade in one bar. So if you sold overvalued at this level right here, I'm always paying attention to significantly overvalued or significantly undervalued occurrences, because they tend to be a good trades from the standpoint. If you don't have a value migration, which typically markets are in consolidation more than they are trending mode, then those can be trades that even if you're trading in a trendless environment, or even with the trend or against the trend, you still could have an opportunity to, take advantage of that. Now, if you have strengthening momentum, like right here in this first bar, you see a lot of red here. That's not the time where I would be looking to fade that. Okay, I wouldn't be looking to sell that. I don't see a momentum picture telling me to sell this right here. Okay, now granted, we don't see to the left here, so we need to scoot over a little bit here to see that a little bit better. Look what's happening here. So this is significantly overvalued. Okay, but we're seeing two things that are cautionary here. Okay, the first one is you're seeing a weakening of downside momentum, okay, a little bit here. And then you're also seeing a strengthening of upside momentum. So that's a situation where you may want to pass, and that's a migration. We're starting to see value migration. But most of the time, the markets are in a lot of these consolidations are choppy periods, and we need to be aware of that. All right. Let me see. Let's go over here and look at any other obvious signs. And these don't come around often, by the way. We want to be very, very picky with these over time. If the pickier we are with these, the better off we're going to be. So I don't see a lot of really clear opportunities here to, for very clearly defined bullish or bearish divergences. We see a couple happen, and this is a 15-minute basis. So this is just one time perspective here. Now, what's happening in the euro currency? Euro currency right now is moderately overvalued, trading in upper yellow, but I don't see anything right now that would necessarily tell me to short this, although you could from the standpoint of we do see a little bit of a weakening here. We see the histograms weakening here, so that could be a trade you could take if you wanted to be a little more aggressive with your trading. You notice that the highs here are right around 1360, and the market right now, I'm sorry, 136 even. Is the high, and we're right now at 135.97. Okay, so how much are we risking there? If we traded this right here, we would be risking 4 ticks. Okay, you're still moderately overvalued. That might be a good trade actually right there. You see a weakening of the histogram values. That might be worth taking. I would say the indicator line is not substantially weaker, but it is a little weaker. The histogram bars are definitely weaker there. So that could be a trade you might want to take. Now the caveat here is, this is an argument against taking this trade, is we're going into the grinder. We're going into the Asian session where currencies just kind of meander and flop, just kind of chop around. So this is due to the time of day where there's less volatility. That may be an argument for me to pass on that. Okay, but if I can get a divergence trade where I can put a stop very close by, I've got value in my favor, trading on the right side of value, and then I'm also seeing this type of action where I'm seeing weaker momentum indicators. That's fabulous. Now, I want to show you something else that most people don't look at, but I can tell you is a terrific tool. I'm going to go ahead and turn off my trend. Actually, I'll leave that on for a second. Let's take a look at 120-minute bars here. Okay, I encourage you, when we talk about the right time interval, the reality is that there's a lot of different time intervals to look at. Now, here's what I'm going to do with my momentum. I'm going to give it a much longer period. Let's try 150, and then let's try maybe 12. Okay. Now, let's see here. Let's see if we can get this. Okay. I'm gonna actually increase my data history here back maybe to 3,000 bars so it doesn't mess up my indicators. Okay, so let's get it now. Okay, that's a little better. Okay, now here's what I'm looking for here. Now this, I'm just trying this out, okay, to see if this is the right setting. Now what I'm looking for is I'm looking for this momentum, longer term momentum, to really kind of give me a clue. And what I'm seeing here is that is a little bit too long term. I'm not really getting the picture that I'm looking for here. I'm going to try 50-38-8 for my setting. Okay, now what am I looking for here? I'm looking for a kind of an obvious weakening here of momentum. Now here's what's interesting right here. Notice you've got kind of the upcycle, you've got the little weaker upcycle right here, and then right down here you have yet a weaker upcycle. Okay, that's what I'm looking for with the indicators here. And really what this is leading me to do, if I see a drill down, this is a 120-minute basis, if I see a compelling picture here where I'm seeing kind of a weakening long-term picture, I could drill down to say, okay, is there something that's showing me on a 30-minute or a 15-minute that would say sell up here near the top? Okay, maybe not, there might not be, but this is kind of what I'm looking for. And the currencies are really relatively smooth. Let me see if I can find if this is really the settings I'm looking for here. But right here, here's a good example of the slight nuances that you can see here with this indicator. Okay, notice right here we have a weakening of, or actually even right here, this is a better example. We have a weakening of this indicator. It's a weaker level than it was previously, and then you have overvalued, you know how you have new highs. So the fact that you're up at new highs here, you're overvalued according to value bars, and you have a much weaker reading here, that can be a very, very nice signal. Okay, right in here, this whole period in here, I don't see anything that would tell me, on this basis at least, that I'm looking at, looking at shorting here. Now we're going long. Now, one thing I'll tell you here is don't hesitate to use negative readings. See right here? See the negative momentum reading on this indicator? Look over here. We see a nice correction. And at least on this chart, we're only getting up in the fair value, but that's okay. So if you see a nice correction into fair value even, and you're seeing kind of a negative momentum inflection, those can be good points too to look at trading really in the direction of the trend. Here's another one right here. Here's a positive inflection. We're very positive with the momentum, and then we see momentum, just the market never really corrects that much, corrects in the fair value, and then really starts to turn back up. When you see this type of action, this type of action is what we call momentum inflection signals. Those can be fabulous. Those can be very, very nice signals. So don't just think in terms of catching the high or the low. If you find nice momentum areas in the market where you're seeing kind of a nice, a rise in momentum right here, and then a nice flattening or a little dip, and then it starts rising again, that can be indicative that you have ways to go on the upside. Let's see here. So this period, by the way, is not, I wouldn't say this is, I'm getting a ton of information from this, but this is just to challenge you to look at different combinations of this indicator. Let's try like a 21, 8. Let's try that. Okay. Excuse me, fighting a little bit of allergies down here in Austin. Okay. We're talking about divergences again here. Every little thing you're seeing in the markets is communicating something to you, and it's a matter of, are we listening, and does it, is what we're seeing something that makes sense to us? So we talked about the inflection points. Okay. Now we're talking about divergences really, but I want you to understand that these signals are very powerful as well. We see a nice rally, and it never gets negative here. We never see any type of strong selling. We see this market dip down into moderately undervalued, and then we see the market start picking up steam again here. So this first tick up here in this bar, even on a 120-minute basis, that could be an indication that we're due for another surge here. So when you see those positive inflection points for the upside or the negative ones to the downside, those can be very meaningful, with the market, especially if you're, so in the direction of the trend can be really nice too. Notice right here what's happening. We have a surge up, and then we have a initial correction here. So we have correction number 1 here, and we have a surge up again, and we have correction number 2 here. So notice what's happening with these corrections. Number 1 here is the strongest, and then you have number 2 here is weaker, okay, and number 3 here is weaker still, and the number 4 here is really weak. Notice what's happening though, is these moderately undervalued price points, when you're seeing these weakening momentum pictures using kind of a little bit longer term settings, those can be really good buying opportunities. You just don't have to risk a lot. Even if you bought in right here in this bar, I'll put a blue arrow underneath it. If you bought right here, as soon as the market reached into moderately undervalued or took out the lows of this previous, the previous low here, so below, call it 132.86, this only goes down to a low of 132.72. So for on a 120-minute basis, that's really not a lot. You're talking about, again, 86 down to 72, 14 pip risk there. So that's not too terribly bad. And then as soon as you see this market pop back up and hit the value target of moderately overvalued, you want to be out. Now, let me tell you what I struggle with as a trader. I struggle with managing to being quick to the trigger. Okay, like this morning in the live trading room, Thomas was actually out, and I'm just not set up to be rapid fire with my trigger pulls, and I need to work on that with my setup here, but Thomas has got an 8-screen setup. I have really a 1 to 2 screen setup because I'm not doing rapid trading most of the time. I'm doing with the work that just doesn't require 8 screens. But the idea behind this is these opportunities are very short-lived sometimes, and so you've got to be quick to pull the trigger when you see these happen. And then also and we all have life to live outside of trading. When you see a market head up towards, call it moderately overvalued, how do you know where that is? You know, I'd ask you a question, how do you know where that is before it happens? There's actually tools out there called value bands and value levels that plot those levels. So you can put, you know, kind of a rough target out there if you wanted to. When you buy undervalued, you can use that as an exit strategy. So value range trading is a dynamite way to trade, but I can tell you, like right here, it barely pokes into moderately overvalued, and it's very short-lived before it has a pretty good correction. Okay. All right, let's get to some other indicators here. This is, again, we talked about this a little bit earlier. This is a situation where it's just a trend filter. That's all I would use that for. This is the indicator I really want to show you to talk about more divergence patterns. Now, you may say, well, you know, this is a trending indicator. Why are we looking at it for divergences? Because it can be a very, very powerful divergence indicator as well. Let's take a look at what I'm talking about. Okay, so even the subtleties here. Do you see right here? We see kind of a stronger trend. This is kind of the same, you know, 2 trending, downtrending points that are similar. And then you see this other one over here, a little bit less. Okay, so this correction down to moderately undervalued here with slightly higher trend indicator reading could be something you want to look at buying. This is what I call very average signal there. This over here is above average. So right here, you're doing a little trading against a trend here, but you see the massive weakening here in the trend indicator. So you've got this big peak over here, and then the small peak right here, and then the market's reversed. So those are the types of things you want to kind of watch out for. And look at the nuances in the trend indicator. So stronger selling, stronger selling, stronger selling, weaker selling right here, and then stronger selling again. So watch out for those little nuances. I don't see anything right here that would necessarily tell me to buy. So sometimes the market just comes down without really having a divergence and shoots right back up. Okay, and that's where you want to more or less just watch momentum in those cases. This one right here, believe it or not, I think is a super divergence indicator right there. Now, when I say divergence, we think of bullish and bearish divergences where prices have to make new highs and new lows, but a lot of times it's just sensing the shift in supply and demand. So right here you see a thrust, you see, you know, a reversal or consolidation, a magenta. You actually get a positive reading here, and then you dip down. This is one of those momentum inflection points right here. You're moderately undervalued. Give yourself a little wiggle room with your stops there, and then you shoot up and you start getting momentum going the upside, a trend going the upside. That can be fabulous right here. Notice right here what's going on. Okay, that's a beautiful one right here. If you notice, we have higher prices. Okay, prices surge up into moderately overvalued. Even if you bought it as soon as it went into moderately overvalued up here. Okay, and that would be at a price level of 136.85. Your high up here eventually is 137.15. So you're talking about 30 ticks. Okay, when you're trading longer term, you know, maybe on a 30-minute price chart, you may want to give yourself a little more wiggle room. Or one thing I might even recommend is drill down to 5 minutes. Once you're overvalued in 30-minute, drill down to 5 for your potential, your signal here. Now, notice that the currencies tend to linger in overvalued sometimes. So having 3 bars trading in moderately overvalued is not unusual. Okay, so in fact, one of the good ways to trade this is, and some people do this, is to look at the lows here. You use your lows as your trigger point. So this now says, okay, you've got my attention. You've got much weaker trend, the MQ trend index reading down here. So you have my attention for a major bearish divergence here. But I know you're going to chop around, and I don't know when you're going to top out. So I'm going to wait until you break this low right here. And that low is at 136.91. Okay, and that happens on this next bar over here. Okay, so that's when the light comes on, and you're not in a closet anymore in terms of understanding where the market's going to go. If you would have done that, you're talking literally very little risk in that case. So look for these breakdowns. If you're a person that would rather not play around with picking tops, wait for a break of the previous low and put your high above the previous bar. Okay, now that worked over here as well. This is not where we was sold, But this is an example. Sometimes the lows are, trading the break of the low can be effective. Okay, let's. I'm going to see if I can even look at different time frames. This is a 30-minute time frame. Check out the 5-minute. Let's look at what happened over here. Now at that top, let's go back over that top we saw. Okay, so this is a situation where we had the, we surged up into moderately overvalued in the 30-minute, and now we see, we're getting a lot of, obviously, momentum to the upside. Now look where your trend indicator rolls over. That's another thing you can use. So as soon as you turn, call it, as soon as you're turning cyan, which is right down here, you are, let's see if we can do this again here. I think it's right. As soon as you turn cyan here, you're in either reversal or consolidation, you're short. Okay, if you did that, you're essentially getting short at this price level right here. So you could do that in the close of that bar. It's 136.97. And you can place your stop if you want the ultimate highs or at the high of maybe 2 bars ago. If you did that, then your worst underwater point, again, 136.97, you're looking at a high of the falling bar, 2 bars, 137.01. That's 4 ticks you would have paying for a lot of downside potential here. So that's one idea as well. That is a really nice bullish divergence there. Now look at what's happening here, even the subtle nuances here of the 5-minute. See what's happening here? You have a little bit of a strengthening here, okay? So you could conceivably buy there if you wanted to in a 5-minute. Now I don't give a lot of credence to 5 minutes because it can be consolidation. That's normal for the market to go in kind of phases of consolidation. Here's another one right here. So if you did on a 5-minute, that's a strengthening here. You're undervalued. Now if you did that, you're buying at the bottom of this trough here. If your market flatlines like this and doesn't really give you a nice bounce, get out. So you don't even need, or as soon as you get a degree of separation, and a degree of separation in my mind is 10 to 20 ticks, 10 to 20 pips. So if you buy right down here at this level, right around 136.64 right in here, and you're seeing the market drift up and you get a high of 136.70, but it's just not going higher, that's a warning sign. So get out of Dodge, live to trade another day. And I would say that would be a very mediocre signal at best. But this just highlights the point that even in this case, had you done that, you probably could be in and break even. Get in at moderately undervalued there, and you could have a break-even stop. Nothing gained, nothing lost there. So I'll do break-even trades all day long because when they do hit, they're beautiful. You can make a lot of money very, very quickly. And once you have the break-even stop in there, and once you get it far enough away where it's not going to come back and poke you out, which is a risk there, then you're in the driver's seat. Okay, this is another case right here. We have a strengthening reading on the MQ trend index, and right here, if you wanted to buy down in here, again, you could look for that first magenta bar, if you wanted to, or you could just buy when it's undervalued here. Now, I would say that this is, again, a pretty weak signal. Okay, these are not necessarily things I'm looking to do myself. In fact, the other thing you ought to be looking at, just the opposite. Notice that what Thomas likes to do, which I think is a great idea, is adding the regression line in here as a filter and making that 100 bars. Okay, so what he would be doing and recommending that you possibly do, and he can chime in here in a minute, he's actually on the call with us, is when you have a red line right there, you see how we're overvalued, moderately overvalued, the trend is red, the trend's down, and look at your inflection point down here. Your momentum, your trend is not even able to get back up to positive. So you have a consolidation period, and then you're right back in downtrending mode. Okay, consolidation, downtrending mode, consolidation, downtrending mode. So this is the area where you really don't, generally speaking, there's a lot of money to be made in the direction of the trend. Okay, and you're seeing that the highs in the trend index are getting lower. See how you have a high here, a lower high here, and a lower high here. It's hard to tell in the histogram, but lower high, and then it starts to right here. Then you start to get a higher low, and that subtle nuance there sometimes is an opportunity to trade in the opposite direction. But I tend not to do it in 5-minute bars. I tend to try to look at that more on a 30 to 60-minute bar basis. Again, possible, entry points as well here. So this is here's an interesting scenario right here. Very subtle here. You have your highs back here at 136.40. You get real close to it. In fact, you touch it right there. Okay, and look at your trend indicators. This is very subtle stuff here. Barely poke up into positive. Okay, so that could be a very low risk selling point as well. Now right down here, see, this is a much more obvious point to me right here. The thing I like about this is that even though the trend's down, if you wanted to try maybe a counter trend trading opportunity, this is what I like to wait for. See how obvious that is? You have a thrust down, a much higher trough here in the trend indicator. So that's where I would like to potentially get in. Now the reality is that we looked at a couple trades this morning in Trading Room, and a couple of them were just dead wrong. I was just dead wrong in gold. Gold just ended up selling off, and in fact, I'll show you gold's in a beautiful 240-minute pennant pattern. Let me see if I can show you that real quick. Once I saw that later, I realized that we ought to be waiting for that thing to figure itself out. Here it is right here. So let me not to digress here, but let's just take a look at that real quick. So gold is going to be confused until it figures out which way it's going to go. And the beautiful thing about what's happening is we are nearing the apex. So gold is going to have to make a decision here at some point, either going up or down. Okay, and so that I'm actually going to wait until it figures out which way it's going to break out. If it breaks out to the upside, then I'm waiting for a trend line retest, probably to get back in undervalued. If it breaks to the downside, you could see this market really start to fall quickly. So I'm just sitting aside right now in gold and waiting for it, because these choppy conditions are really tough to trade in. Okay, let's get back over here. Again, just take a look at the trend index. Trend index is a super indicator right here. Even though, see the higher value here, if you're buying here, now I would also tell you we're looking at a 10-bar period. On a 5-minute chart, I tend to prefer value bars of at least 14 bars, okay, in terms of my, what I'm looking at in terms of my value bars indicator. So that's I tend to look at that. That's at minimum. But if you were inclined to do that, I would really watch, kind of for the shift in momentum and the value at the same time. The bottom fishing can be very expensive. Okay, so really what we try to do, Thomas and I like to, on the crude oil market, for example, that's a good example, and really maybe on the currency market as well, is we like to look for a kind of a solid change in direction. So not fishing for the bottom, but waiting for a bottom to be put in place, and then confirmation that the market's really kind of turned around after that. So some sort of higher low. We were looking for that actually this morning in the currency market, right around this place right here. I think that's right. Yeah, I think right around this time right here, we're looking at these lows potentially, and my stop was too tight, and I kind of walked away from that. But sure enough, it ended up, playing around here for 15 minutes or so, and then it finally took off in the right direction. And the euro currency is going to do that a lot. Okay, again, see what's happening right here with these subtle nuances here. We're seeing weakening right here, a weakening trend value, right? And we're still getting an overvalued. So right there. So that's not a bad trade right there to consider. You see even a lower high, that's okay. And then you have a weakening trend, and then over here, same thing. You have a weakening trending indicator right there, and you poke up into overvalued, it's lower volatility. That's okay. That can be a good trade. As soon as you hit the opposite, moderately undervalued, yellow bars, you want to be out on that one. So now, one thing you could do in terms of these signals, let's go to a little bit longer term, is you could, if you can get in right, we talked about some of these price points earlier where you have a little bit of a divergence here on some of the indicators. If you happen to buy something like this, okay, and you just nailed it, you got undervalued, nice bullish divergence, this is not really bullish divergence in the classical sense, but this is right here, potentially. So that dips down barely below the previous bar, and you have a higher trend index value. If you have a situation like that, one thing you could do is you could either take your profits when you hit the value target of moderately overvalued, or if the trend starts turning up, you could conceivably assign your position to the trend. Okay, right here is where it turns. So, or if you wanted to go longer term. One other thing you could do is you could apply the other trend indicator we showed you previously. So you can say, as soon as this gets triggered, I'm going to get out. So you can conceivably get in, and that's this point right here, potentially, or this point over here, okay, being patient for those points. If you happen to catch it just right like this, and it's very doable, it's very doable to do that, then you could use the trend, to guide your trade. And, you're risking really not many ticks at all. Some of these trades that Thomas and I have nailed in the past literally risk 1 or 2 ticks and just happen to catch the wave right. We had a trade with the S&P 500. Thomas called me up. It was back in November before I had to go to Asia with the Bloomberg tour, and he said, you know, look at the S&P 500. It is right against resistance. It's overvalued. We literally sold a number of contracts right then, and it literally risked, I think, 2 ticks, and it dropped 40 points. So I mean, that's possible. You've got to be able to envision maybe the next leg up. And this is why I always encourage day traders, even if you're trading on shorter term price bars, be aware of the dailies as well. Because if the daily shows a lot of promise to one side, then you could conceivably get in with a really tight risk, and then, you know, not risking but a few ticks, and then ride the wave, ride the swing. And that's definitely possible. But a lot of this is going to be about patience and discipline and waiting for that well-defined situation to uncover itself. Here's another example. We're talking about momentum inflection points. Nice momentum inflection. Hey, we're not buying undervalued there, right? But momentum never dips down very far. So that tells me this market's pretty strong. As soon as you get that first up situation right there, right at that bar, you could buy on the close right there. Momentum's turning up, or trend's turning up, and you're not risking a lot. As soon as the trend turns down, you can get out. So, and that's at this bar right here. Now that's not a bad deal right there. If you can catch that. So trading with the trend is definitely worth it, and looking for all the trading opportunities you can find. You know, again, here, this one right here is not a bad one as well. You could trade that, you know, get in with that momentum or the trend inflection point there. And then sometimes you just don't even get them. Trend just reverses and just doesn't, you know, just ends up sliding hard in that direction. And this is a case where we're looking at some 5-minute trading opportunities right here, but on a 60-minute, I see nothing. I mean, I don't see any buy signals in here. So what I like to do is, instead of looking at the 5 minutes to decide, I like to look at 60, 120, and 240. And then what I do is I like to drill down at that point and just use multiple time frames to put the odds in your favor. Okay, let's see what our time looks like here. Let me give ourselves some. Okay, we're rapidly running out of time. I'm going to go ahead and start answering some questions here. Let me just look at these other charts here. Okay, another thing, the MQ migration. This is a beautiful divergence indicator. Okay, so just look at the subtle nuances here. Right here, see how this? You have a strong surge right here, and look at how you see the indicator line flatlining here, and a much weaker histogram. So, you know, you're fair game selling this area up here, just all in here. And then as soon as you hit down here in the moderately undervalued, you can dump it. This is 5-minute. Again, with 5-minute, I like to use at least 14. Some people even like to use a 21 bar. See if I can pull up a 21 bar value bar just to show you what that looks like. I have one trader who swears by it, loves it. And I really don't use it that much personally, but I'll take his word for it. Now look at 21 bar for 5-minute, beautiful. You have a nice bearish divergence, a weakening there. It's not even bearish typically because you haven't penetrated the highs there, but look at the weakening there of your indicator. I mean, this migration is beautiful. Look at the strengthening right here. Okay, over this one. So you have a sell-off and then really kind of a strengthening here, and you're undervalued. You know, this didn't go very far, and this didn't even reach a value target. But what are you risking? You probably a break-even stop there. Now look at right here what happened. This is beautiful. Right here you have a higher, higher value here, lower, kind of smaller red histogram bars right there. So in fact, I'll expand my screen just a little bit. So see what's happening here. Stronger selling, weaker selling, weaker selling. Migration is a wonderful indicator, very sensitive to this type of thing. So buying in here, you didn't make any money in that one. You probably stopped out at break even, that's fine. But right here, if you bought that, moderately undervalued, you killed it. I mean, you risk literally, you're buying at 135.77 and you're risking the low of 135.76, okay? That's why you have to be quick on the draw with that. And then hit the value target right around, this is 5 minutes basis, so 135.89. So I talk about 10, 12 pips or so after giving up the spread. It's not a bad deal. And by the way, when you put a trade in for a value target, then you can put a limit order in there. So there is no slippage. The bid comes up to meet you if you're selling it, or no deal. And that's a little risky sometimes if you barely get that poke up there, but in general, that's a decent way to trade. But here's the thing: you've always got to remember, if you're rapid fire trading with a 5-minute basis, then you are really you need to be quick on the draw. Be quick to move your stop to break even, quick to place your stop in the market, and so on and so forth. Let's look at maybe a 15-minute chart here. Check out even with the MQ momentum. I mean, look at the weakening here. Even in this area right here, that could be, these could be areas where you can sell. It didn't go anywhere. You probably got stopped out of break even, But look at this right here. You're seeing weaker migration, weaker migration. So if you want to do counter trend, you're not making any money right here, possibly even stopped out for a little bit of a loss there. But if in this next situation you have higher prices, right, and you have a weaker reading right there, beautiful. It barely taps the moderately undervalued there, and then it shoots right back up. So if you have that and you miss that, you may want to, if it touches in there, you want to be out, and at least have a break-even stop in there. Okay, right here, look at what's happening with your indicator line. Okay, weaker. This should be screaming at you. So right here, you have a weaker thrust, even though you have a huge thrust up. And by the way, this is something you want to pay attention to. When you see a surge down in the market like this, I don't see any buy signal here, by the way. So stand aside, but it's big surge down and a very rapid surge up. Okay, that is a beautiful sign. It's like a rubber band. Markets can only typically stretch so far in the absence of some major news or report. If it's just kind of volatile trading or aftermath volatile trading, this is beautiful because it's expended so much energy going up here. You have a much weaker migration index reading down here. That is a great opportunity to sell it up there. Okay, and this is where you can drill down again. We talked about drilling down to the shorter time frames. Migration all the way down here. And again, you see right here, you see kind of a weakening right here of it, but look at how far your prices are still falling off. You're still making pretty good new lows there. So 15 minutes, again, the danger of bottom picking in the indices is that you can get a situation like this where you got weaker right here for this first go around. Okay, so that's right in here. Okay, if you took a trade in there, then you could have used that strategy we talked about where you break the high. Let's take a look at that real quick. Let's say we're wrong. We say, okay, I'm going to buy it in here. Look at that, the strengthening. We have a large down move here in the histogram. It's higher right here. I'm going to buy right here. Now, if you would have bought on the break of this bar, just being conservative, see how you have the lower highs of bars. You have kind of a doji right here, and then you have the breakout above that. So if you bought the high of that bar, which is right around 135.32, you literally, and you risk the low of that bar, which was 135.27, not a lot of risk there, then you're surging all the way up to a high of 48. Okay, at minimum here, that should be a break-even trade for you. Okay, that should be a situation where you don't make any money, you break even, but that's okay. Okay, now this next go around, that's not convincingly higher in my mind. Okay, you can do the same thing again here. In fact, yeah, I don't know if this is one of the days I actually bought, and it stopped me on a break even. I'm trying to recall, but this is again a higher low here in the migration index. So that again, you could buy undervalued there, but you surge up, and nothing happens. You're stalling out here, and you're starting to see your migration line even head south a little bit here. You know what? Get out. If it doesn't do what you want to do fast enough, then you're wrong about your timing. So, but even the nice thing about a lot of these points is that even if you're wrong and the trend's still against you, there's a lot of situations where you can get out break even, which is not a bad deal. All right, let's take a look at one more thing here. Let me see. Did we look at this with a? Let me pull up a 120 and 240 real quick, even though we're kind of running over in time. So sorry to run over in time here, but I want to make sure that we go over everything we want to here. Okay, this right here, one thing I was going to challenge you to on is compress your charts. Sometimes it gives you a much better picture of what's happening. Okay, I don't see a lot on the 120-minute basis with migration here. Just not seeing a lot that jumps out at me that's really effective, with the exception of this, maybe this lower high right here. But you have a huge migration here in this first surge up. So, but this right here, this doesn't seem to me to be quite as effective. Okay, let's take a look at 60 minutes. Okay, 60-minute could be, this is 14. By the way, let me change this last look back parameter to 14 as well. Sometimes that'll give us a little bit different picture. Okay, this obviously is a lower high right here, but and this is a little bit lower high right here. So this is kind of an obvious one. We could have sold it possibly moderately overvalued up there. Inflection point right here in migration. So you could have bought it as we kind of turn up here. We never entered negative territory, and you get a really nice surge up there. Let's see, this right here, you could have potentially sold. It's just a moderately overvalued for a split second. That's probably a break-even trade unless you held it all the way down here to moderately undervalued. But in general, you see kind of a little bit of a weakening here. This is the one thing we're seeing right now. So either we're in consolidation with the euro currency, or prices are getting ready to turn around on us. So, and remember, we talked about selling at the value earlier. I think it was 135.97 with a high of 136 even. So if we sold it at 97, we're a couple ticks in the bank. It's heading down. We're not. That was a 3 or 4 tick trade. So that's one we could have made an argument possibly on. Also, the migration index, the trend index is one I would definitely encourage you to compress to. So let's go 50, 38. I'll just show you real quick what that looks like. Okay. Okay, compress that thing. I mean, get a really long-term view of that. That's 240 minute. Let me try 60 and see if that shows us anything interesting. Now, see what's happening here? This gives us a slightly different picture of what's happening. Look at what's happening right here on these higher lows right there. Those can be meaningful. You're still poking down. You have new lows right here. That's probably the best signal on this whole page or whole charting window. Is this where you have the moderately undervalued point there? Okay, right here, and you have a very clear higher low here. Okay, this is clearly higher than the one before, and this is higher than the one before. So these two trades right there are probably the ones I see that are the most obvious on the screen. But yeah, the trend, this indicator, by the way, when you talk about compressing this, maybe a longer time frame, 50, 38, 8, this works a lot better on some markets like soybeans, okay, and gold, possibly crude oil. But because you have the trending nature of the currency, it's just, in my opinion, on the 60-minute basis, not quite as effective. Let's try 15. Interesting here. I mean, look at how pronounced that is. Much lower high there. Even getting in this area, lower high right here. Inflection point right here. You have an undervalued, and then you have this inflection point, turns right back up. You have a nice surge up into moderately overvalued there. Okay, let's see. I'm just going to show you the last couple of indicators. We can do this another time, but I like the market strength indicator too. Sometimes that'll show you, what's happening with the buy-sell strength. I'd like this indicator also to give me an idea of how far moves are liable to go. It's amazing how consistent sometimes markets can be about how far they surge for a given period of time. And right now this is 5. Let's make this 10. So for 10 hours. Okay, so if you're looking to buy and a market's already surged maybe around, call it 97 or 100 pips, and it's right around this blue area, this horizontal line, be careful, because the market's already realized a lot of its potential. You probably can find a better price. Okay, and then go down here even for the corrections. It's interesting how you see a consistency a lot of times over certain periods, like where the market would just tend to correct when it kind of gets in that zone. It'll correct like 45 pips, 45 pips, 45 pips, 45, 40 pips, but right around there. So that can be another another indication there of combining that with divergences, combining that with value that could be a good lead in potentially to buy or sell. Let's take a look at one other here. The cycle finder. We really haven't touched on this today. Beautiful indicator. Okay, let's take a look at this is on a 15-minute basis. If I wanted to make this maybe a 14-bar analysis period. Okay, this right here, you see a much lower cycle high here. It's a little choppy. So that's the negative part of the cycle finders. It can be a little choppy sometimes, but sometimes it picks up on those subtleties there. Where you see slightly higher bottoms or slightly lower tops and things like that. So let's take a look at 60 minutes, see if or 30 minute. Okay, now with a trending market, sometimes it's a little bit it can be a little bit noisy and not quite as clear. So some markets or some time frames it's clearer than others. If it doesn't tell you a lot, just move on, but study it. It's worth studying. So, and then seeing what if you see any strengthening indications. I like what I call the zero touch trades too with the cycle finder, and that's where the market surges up, right? You have a nice surge up and you come down, and the cycle indicator doesn't really go too far beyond zero or even just touches zero, like right here. Beautiful example of that. Just comes right down here to touch zero and then starts heading back up again. Or right up here, zero touch to the downside. So this point right here where you come back, this touches zero, had a nice surge down, touches zero, you may have poked up in the overvalued in a short-term basis. That's a potential good sell, and then you combine that potentially with a trend line as well, and you have the makings of a nice trade. And that's where you combine as many things as you can that work, and that really increases your probability for success. All right, Thomas, any words of wisdom here? We're now down to 135.93. You know, if you sold that earlier, that's that we talked about that being a possible sell signal. Now look what's happening with Cycle Finder. Weaker top, and a much weaker top here. So right there, if we sold around 97, we're up 4 pips or 3 pips, call it, with a 4 pip risk. So now I would say if it gets down to like 135.85, I'd leave a stop where it is right now, but it gets down to 135.85 or breaks these lows right there. To me, that's a surefire time to put your break-even stop in, and you're really not risking a lot on a trade like that anyways. So yeah. Thomas, do you guys Thomas, are you around? Do you guys use the Cycle Finder in the trading room? I think you say you do sometimes, but I'm not quite sure.
Yeah, we use it actually on almost all the charts during the trading room. It's actually one of the best, in my opinion, for finding divergences.
Okay, well that's good.
Momentum and a Cycle Finder divergence paired together, a lot of times those are the most accurate signals.
Okay, good, excellent. Well, by the way, for all of you joining us tonight, if you're not in the live trading room, it's dynamite. It's better when Thomas does it than I do it. He's dynamite at that, finding those scalps, finding just great trading opportunities. Just really has a great mind for trading, does a lot of homework, and does a super job there. And if you're not a member, we do offer a free pass, I think twice a month on Wednesdays, so just come and join us on one of those free days and check it out. All right, let's take some questions here. I don't know, Thomas, if you've been fielding any of these or want to talk about any of these questions at all.
Just a few, but just so everybody knows, tomorrow is a open house for the live trading room.
Oh, okay, cool.
You can get access to that if they go to Value Charts and sign up for the free newsletter. They can get access to it tomorrow. We'll send out a link in the morning.
Okay, yeah, sure. Jack, listen, you're asking about the MQ migration. What is the scale? Okay, let me see if I can hunt that down. Okay, you're talking about the just the pure migration. See if I find that. Okay, this one. There is no scale on that. It's not scaled like an oscillator. So it's almost like an on-balance volume type indicator. And see, this is the situation where you start to read this, but you're seeing, you know, what you read is there much of a buy migration or short buy migration after the sell? There's not. It's kind of stair-step down here. And this is the type of situation where you might say, okay, we're stair-stepping down here, clearly a sell migration, and I'm looking for that quick pop and overvalued on a 5-minute basis, and I may look to sell that if my migration's kind of stair-stepping down like that. So that's the type of thing you could look for with that. Let's see. Yeah, okay, just a huge number. Yeah, that's right. Well, it is. That's a big number for this, and that there again, it's not scaled to anything. That number is not really correlated to price. It's not correlated to anything. It's really correlated to value charts points. Okay, and those are volatility. They call them dynamic volatility units. So that you kind of ignore the scale and you pay attention more to the action. Okay, and then also when you see something like this, where you see kind of a stair-step, 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 and all of a sudden, guess what? You see an absence of a stair-step. See that really short red there, and all of a sudden prolonged green? That's an indication that something might have changed. Okay, and right, yeah. So it's an indicator. You may like it. You may not find a use for it, but it's kind of an interesting one. And I'm still trying to figure out how I would use that in my trading, but we threw it out there. It's similar to migration index, except for the index is an oscillator. Migration index, I think, is a more useful indicator, in my humble opinion. Okay, Charles, let's see, you've got a question. Any quick thoughts on bonds tonight? Yeah, we can take a look at that. Thomas, feel free to chime in too if you have any opinion here. Let's look at the 30 years here and see what they're doing. Okay, I think bonds, this is my humble opinion, as kind of a trend follower mindset a little bit. Let's see here. The weekly, now what's interesting is the weekly, we've got a long way to trade, so we can't really read that as a yellow jacket doji yet. But let's see here. Let me close up my GoToWebinar. Let's see, yeah, bonds, the only thing I'm looking at that's interesting, Charles, is with bonds is you see that inflection point right here in momentum. So that's the only thing I'm looking at as a potential here. So if that holds in, and we don't know what this next down surge is going to be, But a lot of times when you see those inflection points like this one over here, let me just open up my 120-minute chart here. See this inflection point right here, that negative one? That was followed on by a huge sell-off. I'm not saying that's what we're going to expect now, but it has the feel of that inflection point here. It has the feel of a market that could go lower here. Also, notice that we've also got that inflection point on a daily as well. So I would say if I were trading this market, I'd be looking to the downside, but I don't see a lot of clear things happening. The one thing you want to be wary of is that we're in the moderately undervalued here on a weekly, but again, the markets can stay in those valuation. They can show migration in bonds especially. I can tell you from the hedge fund universe, just talking to hedge fund managers out there, everybody is looking for the big bond sell. Okay, I mean everybody, and then when the hedge fund managers are talking about in terms of months and years, but everybody, and I've seen guys that are talking about increasing the leverage on short bond positions. So that is referred to as the trade of the decade, is shorting bonds, because at some point everybody just seems to have a feeling that they're going to get smashed. Okay, Larry, late to all this. Yeah, we have a recording, by the way. Thomas, that'll be posted up on our website, I assume, right? Sorry, I think Thomas is sorry. Thomas is.
Hey, Mark. Yeah, it should be posted up here in the next couple of days.
Okay.
This recording.
Okay, Jim, you asked about the look-back period. Does what appeared to shift? Jim, do me a favor and just if you want to, just let me know what indicator that was referring to. Was it the trend index or the migration index or the momentum? But I think it was probably, I'm going to take a wild guess here, that look-back period was probably in the migration index, if I'm not mistaken. So let's see, that period right there that's analyzing, what that does is analyze the number of bars back that's being factored into this reading. Okay, so if you, like it's 14, I'm using a 14-bar analysis period. Now that's a value charts analysis period. So that's factoring in how, that has to do with the floating axis in the value charts indicator, and then also how many value charts readings are we looking at, and that's where you look at the 14 there. And I would tell you to just play around with that a little bit. Thomas, do you have any favorite settings there? You can see how the 5 is a little bit more reactive. The 14, I tend to match up, depending on what my analysis period is, I tend to match up my look-back period. Like if I have a 21 here, I tend to put 21 there as well. So although you don't have to. I mean, I can put 21 and 5. So, okay, yeah. See that 21, 5 just gives you kind of a much more fine-tuned look at what's happening there. But I got to tell you, I love the migration index. I love the momentum index as well, and then or momentum indicator, I should say, and then also the cycle finders is a fabulous indicator. And take a look at the trend index. Strangely enough, you wouldn't expect it, but that can be a really good divergence indicator as well. Dave, how do we get training to know what numbers or measures to reset the length of the indicator? Sounds easy. You know what? A lot of us just feel. I would just challenge you to play around with that, Dave, and see if you can find the feel that you're that you're happy with. And sometimes I'll put a setting up there, and I really don't. It doesn't tell me anything. The setting just is kind of. It doesn't shed any light on what's happening. What you want to have happen when you calibrate your indicators is you want to be able to have it shed light on what's happening with supply and demand. So the idea is if you can get your divergences to line up with value, if you trade on the right side of value, that's my biggest edge when trading. When I don't trade on the right side of value, I typically lose money. I mean, just to be totally transparent. Now, and one exception to that is if I'm using long-term trend following models. And in those cases, you've got to write out some volatility and you've got to write out drawdowns. But I would just tell you to play around with the different settings. Longer term will give you kind of a longer term picture of the cycles involved with the price discovery process. Shorter term ones will give you a little more fine-tuned. If you have any questions on that too, we're going to have a session coming up in a webinar. It's kind of an all Q&A thing. So anything you have questions about, it's just all we're going to do is just appear to tell you quickly what's working in trading for us, and we're going to talk about and answer any questions you've got. So I would encourage you to keep an eye on our website as well. Okay, spot forex trader appear in. Let's see, can I use these indicators? Absolutely, yeah, they're good for trading. Lee, great to see you again, and everybody else here, obviously, in the trading room. See, can we set alerts on the histogram when it reaches extreme levels? Yes, you can. Let me think about that. You certainly can do it within the indicator itself, but you know, that's an interesting question that you have there. And what you make me think of, Lee, is a situation where I saw, I think it was crude oil or one of the markets just like blow out the roof, and it reached like really extreme levels on the momentum indicator, and that's one of those once in a blue moon type deals. But that would be a really good, yeah, it'd be really good notice. Now, let me tell you about one thing we're doing that's really cool. We finally have created a Doji indicator. Thomas, you're gonna like this too. Okay, this is a indicator that is going to call out the value, to kind of call out occurrences of value and candlesticks. Okay, now you don't want to trade all of these, but you want to look at it when it pops out. The one that stands in my mind that I'm kind of kicking myself earlier, I was watching wheat, thinking that I might go down and take out the lows, then I got on a phone call and I missed it. But this is a beautiful 15-minute yellow tipped doji right here, right there, 15 minutes. And that, I mean, if you would have bought the other bar next to it and then risked the low, I mean, that was a beautiful situation there. And if you looked at longer term, you would have seen that prices are really overdone to the downside, undervalued across a number of time frames. But this is going to be automated through signal feed. So anybody who subscribes to signal feed, take a look at that. And there's a lot of indicators you just want to, or instances of this that you're going to want to ignore. And Thomas and I are going to work at fine-tuning this and really trying to pick out the choice signals like that one right here with the yellow tip doji. So,
hey,
yeah.
We also have the candlestick reversal course starting Thursday.
You know what?
If they want to learn even more detail on how to actually trade those and
Thomas,
identify them themselves.
Did you think I forgot about you? There it is. Yeah, this is a course I want to tell everybody about as well. If you have any interest in this, Thomas is really doing pioneering work here with combining candlestick patterns with value. It's fascinating. So we're looking at not only a doji, but Thomas has classified a number of dojis, like a yellow hat doji, a yellow tip doji, golden doji, and they have to do with valuation. So not only do you take the probability of a winning candlestick, but you also have the value component. So if you get an overvalued inverted hammer, you know, that can be an excellent sell signal. And the great thing about that is I'm working with Thomas to incorporate these. None of us can, we can't afford to watch these markets all the time across all the time frames. So we're creating a server out there that's going to track all these markets, stocks, forex, futures, and call attention to these dojis and broadcast these. So what you do is when you get the broadcast, just take a look at it. But to really understand how to trade this, and we're the first company in the world, by the way, to introduce this concept, because nobody else on the planet that is talking about value-based value candlesticks. So you are learning. You're gonna learn from the guy who's really leading the charge and pioneering a lot of work in this industry on value candlesticks, and that's Thomas Wood. So check it out. You'll see a lot of him. He uses a lot of these in the live trading room as well. And they turn out to be really good signals many times. Certainly probability of winning more than not from what I've seen so far. Okay, Thomas, have we answered a lot of these questions? I don't know if you've been working to do this while I've been, let's see, I've been presenting here. Let's see here. Okay, Lee, let's see, okay, I think okay, I didn't answer your question, Lee, on that, but Lee, let me check on that question about setting the histogram alerts. I think we can do that, but let me check on that. Let's see, value charts analysis period. I see you sometimes use 5 and 10 based on what you are looking at, not the time frame. Now that's true. Let me just talk about this just briefly. I know we're going over here, and thank you for your patience. But the question is how do you calibrate value charts, okay, or value bars? Now value charts is really the flagship indicator. I'm going to go ahead and throw up a value charts price window so you can see here, and among my many indicators. Okay, so value charts at the bottom is our flagship indicator, okay, and a lot of people like that. Value charts communicates not only value, but has a little bit of momentum component too, and that can be very helpful. Like right here, what's interesting is you see a situation where you see a surge up, you know, kind of a value migration, not unusual here, and then you see the follow-on surge up and the model overvalued, and we're at a much lower. You never really go beyond that. So this kind of communicates a little bit of momentum there as well. Now, there's two different ways to adjust or calibrate the focus of value. Now, we need to understand value is time dependent, okay? Let's use the housing market as an example. People say, well, housing market obviously has come down a long ways from 2007 or whenever it crashed, and we're undervalued now. Well, that's on a shorter term time frame. Now you may say, well, it's it's 7 years or whatever it's been. It's not, or 5 years. It's not that short of a time frame, but the housing market moves very slowly. Real estate does. So if you looked at a 100-year cycle, we may still be very overvalued. So understand that value has a time component to it, and you can have a market short-term overvalued and long-term undervalued. Okay, now recognizing that, there's two ways you can adjust your value focus. One way is to choose a different bar interval. Okay, so I can do that by choosing 1 minute if I wanted to, really short-term value focus. If TradeStation will actually perform the calculation here one of these years, you can do 1 minute, you can do 5 minute for a little bit longer, 30 minute, 60 minute, 120 minute, daily, weekly, and monthly for really long. So this is 1 minute. That's very short term. Okay. Now the other way to adjust that, so this is a very short term. If I went out to daily, then I'm doing a much longer term. Let's see if I can do that here. For whatever reason, my TradeStation is kind of hanging up here, but I think you get the message. Let me see if I can find one of these other charts here to do that on. Okay, this is 30 minute. Let's try to see if that'll work. Daily. Okay, this is daily. Okay, that's longer term, and then weekly is longer term than that. Okay, so that is one way to do it. Now the other way to do it, go back to 60 minutes, is to actually adjust your analysis period. So we hired a PhD from the University of Michigan and he worked with one from UCLA, and then we had another review their work from University of Pennsylvania Wharton. And these were PhD statisticians, and we said, okay, what is the most effective range for value charts in terms of how they work? We don't want to, there's everything in life, every mechanical thing, whether it's a trading system, an indicator, or a machine, there's always boundaries. There's always operating boundaries that you have where it actually functions well within the boundaries and it doesn't outside the boundaries. So with value charts, 5 is the shortest time period, and that looks 5 bars back, okay, at your analysis. In fact, if you want, let me show you a quick indicator here that kind of drives this point home, and that's called value levels. Okay, see that right there? This is value levels, and this is, I'm going to put 5 up there. And if you took the value levels, okay, I'm going to put also the value charts up there as well, below that. Now, value charts window down here, in fact, let me make that 5 as well. That is a linear version of what you see up here. Okay, now, for those of you who say, well, it kind of looks like a Bollinger Band, they obviously the bands, they have the visual appearance is similar, but they're very, very different indicators. If you go to John Bollinger's website, he'll tell you that Bollinger Bands just really try to hit the, target the higher or low or recognize the higher or low from a period. And Bollinger Bands, in my opinion, can be complementary to value charts. Value charts is a little bit different. We're trying to accomplish something a little bit different there, and that is we're trying to define valuation at all times. So there's never any gray area. Green is fair value, yellow, moderately overvalued, so on and so forth, as most of you know. Okay, so 5 bars right here is the shortest time frame you can look at. Now, 50 bars is the longest we recommend. Okay, that's really long term. Look what happens here. Okay, that gets you in a much longer term perspective. Now, some people like that. Let me put that. I'm going to put the value bars in 50 bars too. Okay, so you see how they line up now. Okay, and then I'll put these down here. Value charts, price window. I'll put that at 50 bars too. That's the longest time frame we recommend. And see what's happening here? You're kind of hitting the more of the longer term highs and lows in the market. Okay, so when you're significantly overvalued on a 50 bar basis, that should get your attention. Okay, in terms of market may have overheated. In fact, even if it wasn't the top right here, you can see once you hit that period, you usually get consolidation, unless there's something really special happening. Overvalued, significantly overvalued in the 50, consolidation. Significantly overvalued finally near the top, and you finally get that reversal. So that I would tell you to track that time frame. Now, there's a tool we also have called a price action profile right here, and I can't really get into that tonight, but that is a tool that shows you the degree that a market is overvalued or undervalued. And right now we're trading at fair value according to I say that, let me make sure that price action profile is actually, that may be set to 14. Okay, where are you? Yeah, that's 14. If I made that 50, okay, that would be calibrated just like the rest of them. Okay, fair value as well. Now, the profile is really a very unattractive one here because I don't have that much data pulled up. The more data I have in history, the smoother that profile gets, the more accurate it gets. But that's okay. This generally tells you what's happening and where we're trading on the value charts and how frequently it trades above or below that level. All right, so again, choosing your analysis periods one way from 5 to 50 and anywhere in between. I like 5, I like 10, I like 14, I like 21. 35 is another period that I think is interesting as well that I track in a lot of markets, but they're helpful and there's a lot of information to be gained from each period. Okay, so, and what's interesting is if you get value extremes across a number of different time frames. Like let's say I made my value bars 5 and I made my this is 35, I think. Yeah, I made this, let's say that's even 50. Okay, so I've got 50 bars on my value levels, right? And see how I'm moderately overvalued up here and I'm significantly overvalued. Let's see. Yeah, in these points, there's a couple points where I'm actually significantly overvalued here above the yellow line. Okay, so that would be an attention getter. I'm overvalued, and especially if you can see this point right here, I'm actually significantly overvalued right there, both on the 50 and the 5 right there. And that just happens to be the exact top before the correction. Now I say the exact top of this surge. This is the top of the whole move. But there again, this is almost like a value divergence here. If I pull this back to 5 over here, notice what's happening. We're going back up, but this is a lower high here. So that can be a signal as well. All right, I have rambled too long here, I think, but I can talk about this stuff all night, and my wife doesn't like to talk about trading with me, so I think that it leaves you all to do that. So, all right, we are going to be at the Expo, Jack, good point, in New York, so we'd love to meet all of you if you have a chance to make it. It's a unique event, and we look forward to meeting any of you who can go, and if you can't go, we'll come back and tell you what happened up there. So. That's about it. Listen, our job here at Microquant is to make you a better trader, okay? And it's not just about having the right indicators. You have to, there's a lot of things that go into good trading, but it's possible. It's very possible. It's a matter of really fine-tuning your game and disciplining yourself to follow a certain set of rules, and patience is huge. So don't just turn on the computer and say, oh, this looks like that's going up, I'm going to buy it. I mean, wait for the trades to come to you. Thomas will tell you about that. So. All right, Thomas, any closing words here? I think that tomorrow again is the open house again for the live trading room. Let me pull up one more slide here. So this is again, if you haven't signed up for the Candlestick Reversal, I would say check it out. It's a great course. This is also a new product we have. If you're not aware of this, this is called the signal feed. So Thomas, we're going to broadcast those candlestick signals on this as well. These are things, by the way, these are designed to pay for themselves. You know, if this is not paying for itself for you, then cancel it. I mean, we're practical here. We believe it will. We believe this is going to add value to your trading. We all know that, you know, you can make obviously well beyond $100 in a good trade. So we're trying to keep our prices reasonable and keep them fairly low, but we're going to add as much value to this as possible. We're also going to introduce into the value charts futures. We're going to have a stock one, a Forex one, and an options one here in the relatively near future. And we're going to introduce the value candlesticks that I showed you earlier. So these will all be introduced, and we're going to even fine-tune this and be more picky about the ones we actually select. Take a look at those. I think those can be dynamite, and they can draw your attention to some really good trading opportunities, or good potential trading opportunities. All right, that's it. That's all we have for today. Thomas, any final words here before we close off? I wonder if, Thomas, did you go off the kitchen? Thomas is around. He's probably getting ready for tomorrow's live trading room. But anyways, this is a privilege to have everybody tonight. We appreciate your time, and we look forward to having you, if you have time, to join us in the live trading room tomorrow, although I know many of you are already members, and we thank you for that. Tell us how we can get better, too, at these events. Tell us how we can do webinars better and help you more, and how we can add value to your trading more. With everything we do, with the live trading room, with the webinars we do at night on Tuesday nights, with the signal feed, tell us how we can help. We're here to do that. If every one of our products better add value to you in spades. They're all designed to do that. So if there's something we can do better, then please let us know, because we're definitely very interested in hearing your opinion on that. I'm going to go ahead and check out here, I think, and I thank everybody for joining us tonight. Thank you, Veronica. Lee, thank you, and we will see many of you tomorrow. And if be sure to join us next week as well.